On July 4th, President Trump signed the One Big Beautiful Bill Act into law. This big bill will bring some big changes to our economy, starting with some big tax breaks, to big funding for certain things like more deportations. And the reason why you want to pay attention to this bill and this video is because it goes into effect retroactively. It goes into effect January 1, 2025, so it's going to impact your 2025 taxes. It's not starting next year. Plus, the White House says this bill will help the economy boom, while other people like Elon Musk say it's going to destroy the economy. That's why in this video, I don't want to talk politics. There's enough people on the internet that do that. I want to talk finances, and more specifically, I want to talk about three things. I want to talk about what does this bill mean for your taxes? Number two, what does this bill mean for corporate taxes? And number three, what is this bill going to mean when it comes to the stock market and the economy in general? You want to stick with me through the end of this video because this will help tie it all together. So let's start with number one. What's going to happen to your taxes? As a licensed attorney who's not your attorney, I can tell you that this bill is proposing a lot of changes to your income taxes, but for the purposes of this video, I'm going to focus on the four biggest changes that I saw. Number one has to do with your income taxes. Number two has to do with your standard deduction. Number three has to do with taxes on tips and overtime. And number four is a baby bonus. So let me break down these four. To understand Trump's new income tax plan, you have to know what your income taxes would look like if this one big beautiful bill act was not passed. So if this tax bill was not passed, here's what your taxes would have looked like in 2026. These are all estimates, and I rounded these numbers to make it simple. For every dollar that you earned from $0 to $12,000, you would pay 10% of that in taxes. For every dollar that you earn between $12,000 to $50,000 a year, and this is assuming you're a single filer, you'd be paying 15% of the income in taxes. Up to $120,000, you'd be paying 25% of your income in taxes. For every dollar that you earn between $120,000 to $250,000, you'd be paying 28% of your income in taxes. For every dollar that you earn from $250,000 to $544,000, you'd be paying 33% of your income in taxes. For every dollar that you earn from $544,000 to $546,000, you'd be paying 35% of that money in taxes. And then for every dollar that you earn above $546,000, you'd be paying 39.6% of your money in taxes. If you are married and you're filing your taxes jointly, these numbers would change, but these percentages would stay the same. Now that this tax bill is passed, here's what your income taxes will look like. Now, with the new tax proposal signed into law, the numbers look a little bit different. Again, these are not exact numbers. I rounded everything to keep it simple for this video, but if you're making under $50,000 a year, you're not really seeing much of a difference. But beyond that, you'll start to see a difference because now instead of the next tax bracket being at 25%, it's going to be at 22%, up to $103,000 a year, not $120,000 a year. The bracket after that is not 28%, it's now going to be at 24%, up to $197,000 a year instead of $250,000 a year. Then the next bracket after that is not 33%, it's going to be 32%, up to $250,000 a year, not $544,000 a year. And then the next bracket is going to stay at 35%, but instead of going to $546,000 a year, it's being extended to $626,000 a year. And then the final tax bracket will not be at 39.6%, it's going to be at a top 37% on every dollar that you earn over $626,000 a year. Again, this is for single filers, not married filers. For married filers, these numbers are going to be different as well, but you can start to see that the tax rates, the percentages, are going down, while the amount of money you need to make to qualify for each bracket is also shifting. So what this means in practicality is if you're making over $50,000 a year, chances are you're going to be paying less money in income taxes. But that's not all. The second thing you want to pay attention to is the standard deduction. In 2024, the standard deduction was $14,600 for single tax filers, and for those of you that are married filing jointly, it was $29,200. But now through this new bill, it is going to raise the standard deduction for single filers and married filers. Now again, this standard deduction is a deduction you get to take against your income no matter what. That's why it's called the standard deduction. You don't have to worry about itemizing everything. Everybody qualifies for this. Now, let's take a look at the 2025 numbers. Single tax filers will get a $15,750 standard deduction, while people that are married filing jointly will get a $31,500 standard deduction, which means no matter how much money you make, whether it's under $50,000 a year or more, you will get to qualify for a larger standard deduction. This brings us to the next point. What about the people that are working overtime or relying on tips to make money? What tax breaks do you get? Because you just got a whole new tax break, which by the way, we've been covering in Market Briefs. Again, Market Briefs is my free newsletter for investors, where every day my team is working to break down what's happening in things like the economy, stocks, housing, crypto, and global markets into a fun, witty, and easy to read newsletter. We have hundreds of thousands of investors that are reading Market Briefs every morning. And when you join Market Briefs, you're also going to get access to my investing masterclass as a bonus just for joining, where I'll walk you through how you can get started as an investor and find hidden investment opportunities before everybody else. This investing masterclass plus Market Briefs is completely free. So if you want to join and get access to all of this, all you have to do is click the link down in the description below. This bill gives you a brand new deduction if you earn money from tips or overtime on top of this, on top of the standard deduction, which is if you earn money from tips, you can deduct up to $25,000 in tip income, and it allows you to deduct $12,500 a year in overtime income. But there's a catch. You can only qualify for this deduction if you're making under $150,000 a year as a single tax filer or $300,000 a year as a joint tax filer. So if you work at a restaurant and you're making, say, $60,000 a year, you meet the income requirement, and if $30,000 out of your $60,000 of income is from tips, well, you get to write off $25,000 of that tip income because that's what the tax code says. But if you make over $150,000 a year, well, now you no longer get to qualify for the deduction. So if you're making under $150,000 a year as a single person, $300,000 as a married filing jointly, you get to qualify for this much deduction from tips versus overtime. The other brand new change that we're seeing is a $1,000 baby bonus. If you are a US citizen and you have a baby between January 1, 2025 and December 31, 2028, that baby qualifies for a $1,000 contribution from the United States government into what's called the Trump account. This is kind of like a stock market account. It's supposed to be pegged to the United States stock market, and this $1,000 is a one-time contribution by the government into the baby's account that this child cannot touch until they're 18. Once they're 18, they can access some of the funds to pay for things like college or job training or buying a house. And then after the age of 30, that person will then have full access to this money. So for those of you parents that are thinking about having kids, there's an extra bonus right there. But there's one more thing going on here that I didn't mention here, which is also a brand new deduction, is the senior deduction. And what the senior deduction says is the United States government will give you an additional $6,000 of standard deduction for seniors over the age of 65 just because you're older, so long as you're making under $75,000 a year. After $75,000 a year, it slowly gets phased out until $175,000 a year. Above that, you get no additional senior bonus just for being older. And those numbers are assuming that you're a single tax filer. If you're married, just double it. Now that you understand some of the big sweeping changes to the income taxes, let's talk about what's going on with the corporate taxes, because we also have some big changes going on there too. Big change number one for corporations is keeping the corporate tax rate low, because if this bill was not passed in 2026, the corporate tax rate was going to go up to 35%. But because this bill was passed, it is keeping corporate tax rates at 21%. Now, I want to clarify how corporate tax rates work because I think there's a lot of confusion here. So let's assume that this business is a corporation and it makes $1 million a year in revenue. Now, this business is going to be owned by some person. So let's assume that for my male followers, I drew this mustache, which in my native language Punjabi we call a much. And for my female followers, we have this lady with a braid. In my native language Punjabi, we call this a gut. These two people are the owner of this business. This business made $1 million in a year, but they have expenses. The business has, let's call it $500,000 a year in expenses. That's salary, that's rent, that's softwares, which means the business has $500,000 in profit. Now, this $500,000 in profit is subject to this corporate tax, which in this instance is 21%, right around $100,000. That means this business is now left with $400,000 in income post-taxes. But these owners of the business, you have not made a penny yet. When you take this money out into your personal bank account, well, now you as an individual just made money. And now you have to pay taxes on the money that you just got using the income taxes that I just showed you. This is why corporations are known to have two layers of tax. You have the corporate tax rate, then you have the individual tax rate. You as the owner of the business don't actually make any money until you pull money out. But by the time you pull money out, the money has already been taxed. So corporations have two layers of tax because you have to pay taxes on the corporate side, and then you pay taxes when you pull the money out again, which is why, well, some people like corporate taxes, some people hate corporate taxes. I will leave that up to you. But the second biggest change to the corporate tax code for businesses is an expansion on Section 179. Now, Section 179 gives business owners a deduction when they spend money on business equipment. But to make this fun, when we talk about equipment, let's talk about vehicles. What the new Trump tax bill does is it expands Section 179, meaning it gives business owners a larger potential tax break when they go out to buy equipment, like machinery. But when we talk about something like cars, what this also did is it gives business owners up to a $31,300 deduction on heavy vehicles. Say you want to go out and buy a G-Wagon because your business needs it, well, now you can deduct $31,300. But the interesting thing is, this deduction does not end there, because a G-Wagon might cost you $100,000, which is more than this deduction. And then this new expanded Section 179 says that if you use this vehicle for more than 50% business, you can qualify for an additional 100% bonus depreciation. Which means if I go out and I buy myself a $100,000 G-Wagon and I use this G-Wagon exclusively for business, I use it 100% for my business, well, I get to qualify for this $31,300 deduction, but then I also get to qualify for 100% bonus depreciation, which means I essentially get to write off $100,000, which I know might be a little bit confusing because why do we have this deduction and this deduction? But essentially what this is saying is if you are a business owner and you're using this vehicle exclusively for business, or at least more than 50% for business, you get to qualify for additional bonus depreciation on top of the $31,300 that you're getting through here. The reason why I bring this up is because we saw something similar in 2017 when the Tax Cuts and Jobs Act was passed by President Trump during his first term, and that led to a lot of businesses buying things like G-Wagons. Could this stimulate more G-Wagons being bought and more heavy vehicles for business? Maybe, only time will tell. But what we do know is that history doesn't exactly repeat itself, but it does rhyme. And now that we know what's going on with corporate taxes, let's dive into what does this mean for the economy? What is this going to mean for the stock market? We know that certain companies and certain industries are going to benefit from this tax bill because some companies are just going to make more money. For example, this bill is allocating more money towards deportations, which is going to benefit some of the private prison companies in the United States, which is why we saw some of these private prison stocks rally when this bill was passed. We know that this bill is trying to encourage people to have more babies because it's paying people to have babies. And if that happens, if we do see any growth in population, that could benefit some of the childcare companies and stocks in the United States if they get more business. We know that this bill is going to allocate an additional $150 billion in defense spending, which means that some of the defense companies in the United States are going to get bigger and more contracts from the United States government, which is good for those defense companies and the defense stocks. This is what I say being an active investor is all about, that you want to pay attention to market shifts. All of this is a government shift. There are changes in government policies which is going to change where some of that money is flowing, which is going to create some investment opportunities. These are the things that we cover in Briefs Pro. Again, Briefs Pro is a paid service that we offer at Briefs Media, which helps you stay on top of what shifts are happening and which stocks could benefit for those of you that are investors and want to know where to invest your money. Again, not for everybody, but if you are investing, you can check out Briefs Pro if you are interested in that. But when it comes to just the stock market in general, we can take a look at history and see that tax rates and the stock market are not directly correlated, so it's hard to predict what the general stock market is going to do based off of tax cuts by themselves. But if we go beyond just taxes and we look at the economy at large, what we do know, according to the Congressional Budget Office, is that this bill is expected to add another $3 trillion or so to our national debt over the next decade. Why does that matter? Because in general, when the government spends money they don't have, which is our national debt, our national deficit, when the government spends money they don't have, that creates some sort of inflation. Now, we know that inflation hurts the prices of things. It makes things more expensive. We've all seen that. But at the same time, inflation benefits stocks. At the same time, inflation benefits asset prices. At the same time, inflation benefits rental prices. So, for investors, this is good news. For the average person, more national debt is not good news, because more national debt means more inflation. More national debt means more of our tax dollars are being used to pay off interest on the national debt. This is why you want to pay attention to this. Now, we don't know exactly what's going to happen to the prices of things, if it's going to have a significant impact on the prices of things or not. Maybe it will, maybe it won't. Couple that with tariffs, there's a lot of uncertainty. But what we do know is, in general, when you see national debt go up, stocks go up over the long term. This doesn't mean we're not going to see a market crash. This doesn't mean we're not going to see a recession. We will see a recession. We will see a market crash. We have seen 16 recessions over the last 100 years. We've seen 25 market crashes over the last 100 years. They're going to continue to happen. But as the government spends more money, that boosts the economy. Yes, there's a cost to that. I'm not saying there's no cost to that. The most expensive kind of money is free money. There is a cost to that, which is inflation. However, as an investor, you want to understand how these things impact different parts of the markets. That way, you can find the best opportunity for you, protect your money, protect your wealth, and protect your family. That's why this financial education is so important. That's why you want to pay attention to this bill, because yes, this bill is going to benefit some people more than others. This bill is going to create opportunities for some investors, and this bill is going to impact our economy. And I hope that this video has given you the education to understand not only what's happening, but how you can start to find the opportunities. Again, if you want some more resources, you can check out Market Briefs, then get my Investing Masterclass all for free. I have that link for you down in the description. If you are an investor and you want to find market shifts, you can always check out Briefs Pro. And the best thank you, if you got value out of this video, is to share this video with a friend or a colleague to help spread this financial education. If you make $80,000 a year from your job, you need to make $80,000 a year from your investment income to be able to quit your job and live your life without changing anything you're doing. With your job, you have to go into work every single day to keep getting paid. With your investments, once you put your money to work, it'll keep paying.